Understanding privatization, definition, types, and implications. Privatization refers to the process through which a government-owned business, operation, or property transitions into private ownership, effectively shifting control from the public sector to a private, non-governmental entity. This process can also encompass the transition of publicly traded companies becoming privately held, often termed corporate privatization. Key takeaways. Definition of privatization: the transfer of ownership of government-run operations or assets to private entities. Efficiency gains: advocates argue that privatization can lead to improved efficiency, as private companies are typically incentivized to minimize waste and respond more swiftly to market demand. Criticism of impact: critics of privatization raise concerns, particularly regarding essential services such as education and healthcare, suggesting that these should not be subjected to market forces or profit motives. How privatization works. The process of privatization can vary widely, but it typically involves the government transferring the ownership or management of specific assets or services to a private firm. This action is motivated by a desire to save costs, enhance service quality, or improve operational efficiency. Public sector versus private sector. An economy is generally split into two main sectors. Public sector, run by government agencies, including services such as public education, transportation, emergency services, and public parks. Private sector, composed of privately owned businesses that operate for profit. This includes industries ranging from healthcare to retail, tech, and finance. Privatization predominantly pertains to government-to-private transfer. However, the concept also encompasses corporate privatization, whereby publicly traded companies revert to being privately held. This shift can provide greater operational flexibility and immunity from stock market volatility. Corporate privatization. When a public company opts for privatization, it typically aims to liberate itself from regulatory burdens and shareholder oversight that may hinder its operational reforms. A notable instance of corporate privatization is that of Dell Incorporated, which went private in 2013 after a buyout by its founder, Michael Dell, and a group of investors. The company sought to execute critical changes without the constraints imposed by public ownership. Dell later transitioned back to public trading in 2018, reflecting the cyclical nature of corporate ownership formats. Advantages and disadvantages of privatization. Advantages. 1. Increased efficiency. Proponents argue that private firms can often carry out services more economically and efficiently, leveraging competition and a profit motive to minimize waste. 2. Reduced government burden. Privatization can lessen the financial burden on the government, allowing it to reallocate resources to other pressing needs. 3. Greater innovation. Companies driven by market competition may drive innovation more effectively than bureaucratic systems. Disadvantages. 1. Access issues. Public goods such as water, electricity, and education could become less accessible under a profit-driven model, particularly for lower-income populations. 2. Quality concerns. There is a fear that privatization may lead to a decline in service quality, as unsupervised private entities might prioritize profit over quality or safety. 3. Inequitable outcomes. Specific cases highlight the emergence of social inequality. For instance, in the privatization of Russian industries post-Soviet Union, the process led to a concentration of wealth among a select few, often termed oligarchs. Real-world examples of privatization. One significant case of privatization in the United States occurred in Washington state, where prior to 2012, all liquor sales were controlled by the state. In a move toward privatization, the state allowed private businesses to sell liquor, resulting in the closure or selling of government-run stores and a shift of sales revenue to private owners. An internationally recognized moment of privatization happened following the dissolution of the Soviet Union, which saw a frantic wave of privatizing government enterprises. Although aimed at fostering a market economy, it resulted in profound economic disparities and a shift of wealth and power into the hands of a few. Types of institutions subject to privatization. Various entities may undergo privatization, including but not limited to prisons. Many local and state jails are transitioning to private management in hopes of reducing costs. Critics argue that for-profit prisons can lead to ethical issues, including poor conditions and mistreatment of inmates. Public schools and universities. Some educational institutions are being handed over to private management to improve perceived inefficiencies. Public utilities. Essential services such as water and electricity are also being considered for privatization. Transportation infrastructure, airports, highways, and other transportation services are often managed by private enterprises for efficiency purposes. Conclusion. Privatization is a multifaceted and often contentious issue, straddling the line between improved efficiency and increased inequality. While supporters praise its potential for cost savings and better service delivery, opponents caution against the potential risks posed to essential public services. Understanding the context and implications of privatization can aid in making informed decisions about its appropriate applications in the public sector.